Good afternoon. Thank you all for joining us. I am Avni Shah, the Executive Deputy Superintendent for Insurance here at the DFS, and I'm joined today by Joanna Lukashuk, Deputy General Counsel for Insurance, and John Martini, Deputy Superintendent for Property. So today's webinar is on the department's July 1st guidance titled 2026 Motor Vehicle Insurance Reforms, which outlines auto insurance reforms enacted in the recent New York State budget. As these reforms take effect, the department is committed to working with insurers, trade associations, and other stakeholders to provide guidance to assist in the smooth implementation of these reforms. So without further ado, let's dive in. So today's agenda includes an overview of the July 1st circular letter, and the department's expectations for insurers authorized to write auto insurance in New York, as well as a Q&A portion. We aren't able to take live questions today, but thank you to all of the entities and organizations that submitted questions ahead of today's webinar. So with that, I will turn it over to Joanna to describe the legislative reforms addressed in the circular letter.
Okay. Thanks, Avni. So just a brief overview of some of the reforms that were, these are the reforms that are addressed in the circular letter, but some of the reforms that were done in the budget. And we're going to talk a little bit more in depth about each one. So the first one is the expanded definition of Fraudulent Insurance Act. The budget amended Penal Law Section 176.05 to expand the definition to include a person who hires, requests, encourages, orchestrates, or invites another individual to stage a motor vehicle accident. And it also added language to make clear that this kind of person is deemed to have wrongfully taken, obtained, or withheld the full amount of loss to the victim or victims of the Fraudulent Insurance Act. And this amendment already took effect. It went into effect on May 27th. These next changes have to do with serious injury and non-economic damage amendments. So let's start with the first one, the definition of serious injury, which is in Insurance Law Section 5102D. That definition of a serious injury was amended to remove what we call the 90-180 part of the definition. So previously, that part of the definition referenced a medically determined injury or impairment of a non-permanent nature that prevents the injured person from performing substantially all of material acts that constitute such person's usual and customary daily activities for not less than 90 days during the 180 days immediately following the occurrence of the injury or impairment. That was removed from the definition. So that is no longer considered to be a serious injury. Another change that was made was to Insurance Law Section 5104. And in that section, basically, language was added to say that first, the trier of fact must determine fault, and then serious injury, and then assign liability. So it's what we're calling a procedural sequencing change. In addition, this section was amended to put a cap on non-economic damages in certain actions. So basically, there's a cap of $100,000 for non-economic damages where the injured person was operating an uninsured motor vehicle that the person was responsible for insuring under the Vehicle and Traffic Law, Article 6, except if there's a lapse in coverage of less than 30 days. If the person was operating a motor vehicle while impaired at the time of the accident and convicted of such an offense. And this definition of impairment, this means both intoxication and a drug impairment. Okay, so to make that clear, is if they're impaired by alcohol or drugs, the language is based on the language in Vehicle and Traffic Law, Section 1192. And the third situation where there's a cap is when the person is operating a motor vehicle in the commission of a felony or immediate flight therefrom at the time of the accident and then convicted of the felony. And the cap does not apply in an action for injuries resulting in death. The third one is the amendment to CPLR Section 1411 regarding modified comparative negligence. So in this amendment, basically in any action to recover damages for personal injury that's subject to Insurance Law Article 51, The culpable conduct attributable to the claimant bars recovery if the culpable conduct of the claimant is greater than the culpable conduct or of the person or persons against whom recovery is sought. One thing you should note is that this did take effect already on May 26, 2026, but it is not a straight effective date. The changes apply to all actions and proceedings commenced on or after May 26. So if an action or proceeding was commenced before May 26, these amendments do not apply to that action or proceeding. And finally, we address the amendment to flexible rating, and this is in insurance law section 2350. So this is flexible rating for non-business motor vehicle insurance. And this amendment prohibits an insurer from flexing up. So you can no longer flex up within the 5% ban without the superintendent's prior approval. However, insurers can continue to flex down. This takes effect November 27th of this year. So now I'm going to hand this back over to Avni.
Thank you, Joanna. So now that we've covered the different aspects of the reforms, I'm going to talk about what insurers need to do to incorporate the impact of those reforms into pending and future auto rate filings. So as discussed in our guidance, the reforms are expected to materially reduce expected losses for carriers. Other states that have enacted similar reforms, like Florida and Michigan, have seen significant reductions in costs and premiums. So given this new post-reform landscape, DFS is asking auto insurers to complete a new exhibit for all pending and future auto rate filings. The exhibit is called Exhibit TR1, Automobile Tort Reform Calculation. And it is the first item on the updated rate filing sequence checklist, which can be found on the DFS website. So the instructions for the checklist essentially require companies to provide two things. One, the percentage decrease in anticipated claims and loss adjustment expenses resulting from the reforms. And two, a complete and detailed explanation of how that percentage decrease was derived. This includes specific calculations, actuarial process and procedures, methodologies, and assumptions. So all pending filings that are not withdrawn should be amended to incorporate the impact of the reforms in the new TR1 exhibit by August 31st of 2026. This will happen in the form of objection letters and responses in the SURF system, so companies don't lose their place in line. And companies that need more time to complete their exhibits can request an extension. All new auto rate filings must incorporate the impact of the reforms in the new TR1 exhibit as well, but there's no deadline there, as companies can choose, if and when they want to make a new filing. And then the last thing I wanted to mention is that these requirements also apply to all pending and future filings that are subject to flex rating under insurance law section 2350. So with that, I will turn it over to John Martini, the head of our property bureau, to walk us through answers to some of the questions that we've received since the circular letter was issued.
Okay, thank you so much, Avni, and thanks to all the insurance companies and entities that have reached out to us with their questions. Let's go through some of the main recurring ones that have been submitted since the circular letter was issued. The first one we've seen a lot is, are all carriers required to make auto filings at this time based on the new reforms? While we truly anticipate that the new reforms impact all auto rate filings, there's no legal requirement for an insurer to make a filing at this time. However, it should be noted that any new rate filing submitted by an insurer must incorporate the impact of these reforms in the Exhibit TR1, which is part of the revised rate filing checklist and can be found on the DFS website. The next question, what will happen to filings currently in the course of review at the DFS? Effective July 1st, 2026, when Circular Letter 3 was issued, DFS will not be approving any rate filings that do not reflect the impact of the recent legislative reforms on their loss costs. With respect to any pending rate filings containing data that would be impacted by these reforms, Over the next few weeks, DFS will file an objection letter through SURF requiring the insurer to resubmit their filing with the impact of the reform included on their TR1 exhibit. As mentioned, DFS will not reject the existing filings, but rather issue an objection letter. This ensures that the insurer will not lose their place in line in the filing process. If no response to the objection letter is received within 60 days of being sent, the file will be closed and a full resubmission would be required to move forward. However, it should be noted that if needed, the DFS is willing to grant the filer additional time to complete Exhibit TR1 as appropriate. Can the information in Exhibit TR1 be protected as confidential material? If an insurer wants to request protection of the information in their Exhibit TR1 from public disclosure, the insurer should mark the relevant portion of the exhibit as confidential trade secret pursuant to Public Officer Law 89.5 and explain why the information should be subject to trade secret protection and accepted from disclosure. Any request for these materials will be treated like any other FOIL request in accordance with our standard protocols. How will flex filings be handled before November 27th, 2026? For any flex rate increase filings that are currently pending before DFS, or any future flex rate increases to be filed prior to the effective date of the law change in November, Exhibit TR1 must be filed with DFS and included in the submission. What if we do not have data to definitively model our expected savings? It's indisputable that the reforms enacted this year will materially reduce expected losses for insurers. All companies maintain comprehensive claim data. We expect each company to evaluate its own historical claim data on a case-by-case basis in order to quantify the impact of the reform and the impact the reform would have on these claims. Similar reforms have also been enacted in other states, and that might be instructive as well. Companies should submit data, sources, and methodologies sufficient to support their filings to demonstrate how the reforms impacted their rates. We recognize that the initial filings will be based on projected impact and expect companies to refine their analysis in future filings as actual data is collected over time. What additional guidance can be provided on how to complete Exhibit TR1? At this time, we're not providing additional guidance beyond the circular letter and this briefing. The guidance requires insurers to provide an explanation for the impact of the reform along with the supporting data in their filings. These will be closely scrutinized by the DFS actuarial team. DFS is not providing specific prescriptive advice on or templates on the completion of Exhibit TR1 because the impact of the reform will vary from company to company. Companies should model and provide a reasonable explanation for their estimates with as much detail and supporting data as possible. As mentioned, we expect in future years, as companies generate actual data for the impact of these reforms, these models will become more detailed. Additionally, DFS actuaries may provide feedback or ask follow-up questions on the filings that are insufficiently detailed. Can DFS provide guidance if rates remain neutral? Even if insurers submit rate neutral auto filings, DFS expects them to complete Exhibit TR1 to demonstrate how the reforms are impacting their filing on an overall basis. Will DFS approve auto rate filings that include an overall rate increase, even with the expected savings from the reforms? The reforms enacted this year are expected to result in a significant savings across all auto insurers. We will continue to review any filing, even those that include an overall rate increase, as long as it includes an appropriate estimate of the expected savings from these reforms. As previously mentioned, all filings must be thoroughly justified and will be closely reviewed. I believe that's the last of our questions for today's session, but just wanted to add one last closing comment. Aside from the questions we've addressed here, we've obviously also received a number of additional questions specific to particular individual filings. Our examiners will continue to work to provide detailed feedback on those pending filings as appropriate, including acknowledgements, approvals, and objection letters where necessary. Thank you, everyone, and Avni, I'll turn it back to you for any additional comments.
Thank you, John. That brings us to the end of today's webinar. We do want to close by emphasizing the department's commitment to working with insurers and stakeholders to provide guidance where necessary to assist in the smooth implementation of these reforms. Any additional information, including the circular letter and this webinar, which will be posted on the DFS website shortly, can be found at dfs.ny.gov. I'll also note that there is information about a separate change to the law, New York Insurance Law Section 2356, relating to premium change explanations on the DFS website. So please take a look at that as well. So thank you all for your engagement and for joining today's webinar. Have a wonderful day.